Welcome to Stock Talk. We're jumping straight into Coca-Cola's first quarter 2025 results today. We've got the latest earnings analysis right here. And our mission, as always, is to pull out the really key insights for you, nice and clear.
Exactly. Cut through the noise, get to the heart of how Coke performed. Let's make sense of these numbers quickly.
Okay, let's start with the headline figures. Reported net revenues, they're actually down 2%, landing at $11.13 billion.
Right, but hold on. That number needs context immediately.
Absolutely. The big factor here is currency. They got hit with a 5% headwind.
A significant hit. Think about it. For a company operating globally like Coke, currency swings can really mask the underlying picture.
Totally. It's like, running uphill, your actual effort is stronger than the final speed suggests.
Precisely. So beneath that 5% currency drag, how's the core business actually doing?
Well, that's where it gets interesting. Their organic revenue growth. And just to remind everyone, that strips out currency, M&A, structural stuff that came in at a pretty solid 6%.
6%. Okay, so the actual demand and pricing power, that's looking healthy.
Yeah, despite what they're calling a challenging macroeconomic environment.
And they're attributing that 6% mainly to effective pricing strategies and also continued momentum, particularly in developing and emerging markets.
Makes sense. Now let's talk operating income. The reported number shows this huge jump, like 71%, up to $3.66 billion.
Whoa. Okay, again, context is crucial, right?
Definitely. You have to remember, last year's Q1 figures included a big impairment charge related to Budweiser. About $760 million, I think.
Exactly. So that comparison makes this year look artificially inflated. A better measure is the comparable operating income.
Right, the adjusted number. And how does that look?
More modest. It's up 4%. Still positive growth, but not that dramatic 71%.
Okay, 4% comparable growth.
But, and this is key, if you also strip out the currency impact from that comparable figure, the growth jumps to 10%.
So 10% growth in constant currency on a comparable basis. That paints a much stronger picture of underlying operational performance.
It really does. It shows the core operations are improving nicely once you account for those one-offs and currency fluctuations.
Now, drilling down a bit more, you mentioned 6% organic growth, but constant currency net revenue growth was only 3%. Why the 3% gap there?
Good question. That difference is mainly down to their ongoing refranchising activities. Think India, Bangladesh, the Philippines.
So selling off some of their bottling operations.
Exactly. Those structural changes impact the reported revenue figures even on a constant currency basis, but they aren't part of the organic growth calculation, which looks at like-for-like operations.
Got it. Okay, what about margins? Gross margin looked pretty stable, right? Around 62.6%?
Yeah, holding steady there. But the comparable operating margin saw a nice expansion, up 134 basis points.
To 33.8%, that's quite strong.
It is. It really points towards, effective pricing power, but also good cost management happening behind the scenes.
And that flows through to the bottom line, the EPS.
It does. Reported EPS was up 5% to 77 cents. Comparable EPS, though, was up just 1% to 73 cents.
Only 1%. Again, the currency impact.
Primarily, yes. Because if you look at comparable currency-neutral EPS, that grew by a much healthier 6%. See the pattern. Currency is the big story obscuring some underlying strength.
Definitely seeing that pattern. Okay, let's switch gears quickly to cash flow. The headline number looks, well, startling. Negative $5.51 billion in free cash flow.
Yeah, that jumps out, doesn't it? But there's one very specific, very large item driving that.
Let me guess. Fairlife.
Bingo. There was $6.07 billion payment in March for the Fairlife contingent consideration. That's a huge one-time cash outflow hitting this quarter.
Okay, so that explains the negative headline number. If we mentally back that out, what does the underlying cash generation look like?
If you adjust for that Fairlife payment, their adjusted free cash flow for the quarter was actually positive $558 million.
$558 million positive. And they're saying that's an increase from last year.
A healthy increase is how they termed it, compared to Q1 2024, when you also adjust for Fairlife-related items back then. So operationally, cash generation looks decent once you exclude that massive payment.
Good to clarify. Let's quickly touch on the segments. Any standouts?
Latin America really shown 13% organic growth.
13%. That's huge.
It is, especially when you consider they also faced a massive negative 16% currency impact on the reported revenue there.
Wow. So incredible underlying performance despite the currency headwinds. Shows real resilience.
Absolutely. EMEA and Asia Pacific were also strong, both posting 7% organic growth. Again, though, significant currency impacts hit their reported numbers. And in Asia Pacific, you also had the refranchising effect we talked about.
And North America, how did the home market do?
Steady. Solid 3% growth, both reported and organic. Currency wasn't really a factor there. The big jump in reported operating income in North America was mostly due to that prior year bodge armor charge not repeating. Comparable operating income growth was a more normal 4%.
Okay. And bottling investments, down a lot reported.
Yeah, reported revenue down 20%, but almost all of that, 18 points, was due to refranchising. The remaining operations actually grew organically by 2%.
Right. So just to recap those non-GAAP terms quickly for everyone listening, organic revenue, comparable operating income, comparable currency-neutral EPS, adjusted free cash flow.
They're all designed to give you a clearer view of the underlying business performance by removing the noise from things like currency swings,
Hmm.
one-off gains or charges like impairments or the Fairlife payment, and structural changes like refranchising.
Crucial for understanding the real trends this quarter.
Definitely.
So looking ahead, what's the outlook? Did they change their full-year guidance?
Nope, they maintained it. Still guiding for 6-7% organic revenue growth for the full year 2025.
Okay. And EPS?
Comparable EPS growth expected to be 4-5%. But importantly, that includes an anticipated currency headwind of also 4-5%.
Ah, so if you strip out that expected currency impact.
Then the comparable currency-neutral EPS growth guidance is 8-9%, again showing stronger underlying profit growth expectations.
And free cash flow for the year, still expecting around $9.5 billion.
Yes, around $9.5 billion, but that's explicitly excluding the big Fairlife payment made in Q1.
Okay, so guidance maintained despite the headwinds. What are their key focus areas going forward?
Pretty consistent themes. Revenue growth management, that means balancing price and volume, continuing to push hard in developing and emerging markets, optimizing the portfolio, and driving productivity for margin improvements.
Makes sense. So if we think about risks and opportunities balancing out.
On the opportunity side, you've definitely got that strong emerging market growth potential. Continued margin expansion if they execute on productivity, innovation in areas like coffee, sports drinks, even ready-to-drink alcohol, digital and e-commerce growth,
Yeah.
and maybe eventually currency stabilizing could become a tailwind.
And the risks.
Well, the flip side, those currency headwinds could persist or worsen. Inflation is still a factor globally. Consumer preferences can shift. Regulatory pressures around sugar taxes or packaging are always there, and just general economic volatility.
Okay, so wrapping this quick dive up, strengths seem to be that solid organic growth, the margin expansion, good performance in emerging markets, effective pricing, and decent underlying cash flow once adjusted.
Exactly. And the key focus areas are managing that currency challenge, getting the price volume mix right, expanding in growth categories and geographies, and finding more efficiencies.
So the underlying business looks pretty resilient, even with the currency noise and that big one-off payment.
That's the main takeaway, I think.
Okay, a final thought for you listening. We saw that strong organic growth in places like Latin America compared to more modest growth in North America. What might that geographic divergence mean for Coca-Cola's strategy long term? Where will the focus increasingly need to be?
Yeah, something to ponder. How does that potentially shift resource allocation or product focus down the line? Definitely worth thinking about their global strategy and those emerging market trends.
Great point. Okay, that wraps up our quick look at Coca-Cola's Q1. Thanks for joining us on Stock Talk.